Ray Dalio and BlackRock warns the Fed won't do QE this recession. 3 reasons why what worked in the past will not work now. We have Blackstone limit withdrawal from the real estate fund. We have BlackRock, the world's biggest asset manager, says get ready for a recession unlike any other. And what worked in the past won't work now. Has the market pricing in the Fed going to raise short-term rates to 5% or 6% yet? What damage has market pricing in so far? What are the 3 reasons why what worked in the past won't work now? Does that mean long bond like TLT is still a good hedge against next year's recession? Will the market ever crash now? Now that the big banks are forecasting a 20% drop in stocks. Why is Ray Dalio still worried about inflation next year? I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Markets aren't pricing in the Federal Reserve pushing rates toward a very harmful, very damaging level, according to billionaire investor Ray Dalio, warning investors that an impending drop in the stock market could be in the cards. In an interview with Business Today on Wednesday, the Bridgewater founder said inflation may settle at 4.5% to even 5%, still above the Fed's 2% target, meaning policymakers would have to raise rates to a level approaching 6%. The Federal Reserve will put the short-term rate up towards that level, which is very harmful, very damaging to the economy, he said. But what the Federal Reserve is trying to do is balance those, having an interest rate that's high enough for the creditor, but not so high for the debtor. And so what you're going to see is a slowing of the pace of the rise, but still approaching over 5%, probably in the vicinity of 5.5%. This will still have an effect on all markets, particularly stocks. Previously, Dalio estimated rates past 4.5% would spark a recession and a 20% drop in stocks, in line with predictions from Bank of America, Morgan Stanley, and Deutsche Bank. But that damage hasn't yet been priced into stocks, adding that markets have discounted a fall rather than an increase in rates, as well as a fall in future inflation. Inflation cooled ahead of economists' expectations to 7.7% October. But that was largely been spurred by external factors like falling oil prices, Dalio said. And prices could stay higher for longer as well. What you see built into the yield curve today is a fall off in rates and a fall off in inflation, but I believe that you'll see it staying higher than those levels that are built into market expectations. Now, he added, that's upping risks for stagflation, something economists have been eyeing as inflation skyrocketed to a 41-year record this summer. BlackRock says get ready for a recession unlike any other. And what worked in the past will not work now. A worldwide recession is just around the corner as central banks boost borrowing costs aggressively to tame inflation, and this time it will ignite more market turbulence than ever before, according to BlackRock. The global economy has already exited a 4-decade era of stable growth and inflation to enter a period of heightened instability. And the new regime of increased unpredictability is here to stay, according to the world's biggest asset manager. That means policymakers will no longer be able to support markets as much as they did during past recessions. Recession is foretold as central banks race to try to tame inflation. It's the opposite of past recessions, they said. Central bankers won't ride to the rescue when growth slows in this new regime, contrary to what investors have come to expect. Equity valuations don't yet reflect the damage ahead. The prospect of limited policy support means investors need more dynamic methods involving more frequent portfolio changes and taking more granular view on sectors, regions, and sub-asset classes to navigate the volatility ahead. Regime of greater macro volatility. What worked in the past won't work now. The strategist said the old playbook of simply buying the dip doesn't apply in this regime of sharper trade-offs and greater macro volatility. We don't see a return to conditions that will sustain a joint bull market in stocks and bonds of the kind we expected in the prior decade. A slowdown in the housing market, delays in corporate investment plans, and a decline in consumer savings and deteriorating CEO confidence are early signs of the oncoming economic slump, according to BlackRock. Still, the stock market hasn't yet factored in the potential magnitude of the impending economic downturn. We don't think equities are fully priced for recession. Corporate earnings expectations have yet to fully reflect even a modest recession. This keeps us tactically underweight developed market equities. The new regime calls for rethinking bonds. Our second theme, higher yields are a gift to investors who have long been starved for income, and investors don't have to go far up the risk spectrum to receive it. We like short-term government bonds and mortgage securities for that reason. We favor high-grade credit as we see it compensating for recession risks. On the other hand, we think long-term government bonds won't play their traditional role as portfolio diversifies due to persistent inflation, and we see investors demanding higher compensation for holding them as central banks tighten monetary policy at a time of record debt levels. Here are the 3 reasons why this time there won't be a QE. Number 1, aging populations mean continued worker shortages in many major economies. Number 2, second, persistent geopolitical tensions are rewiring globalization and supply chains. Number 3, the transition to net zero carbon emissions is causing energy supply and demand mismatches. Recession is foretold as central banks race to try to tame inflation. It's the opposite of past recessions. Loose policy is not on the way to help support risk assets in our view. That's why the old playbook of simply buying the dip doesn't apply in this regime of sharper trade-offs and greater macro volatility. The new playbook calls for a continuous reassessment of how much the economic damage being generated by central banks is in the price. According to BlackRock, in the old playbook, long-term government bonds would be part of the package as they historically have shielded portfolios from recession. Not this time, we think. The negative correlation between stocks and bond returns has already flipped, as the chart shows, meaning they can both go down at the same time. Why? Central banks are unlikely to come to the rescue with rapid rate cuts in recessions. They engineered to bring down inflation to policy targets. If anything, policy rates may stay higher for longer than the market is expecting. Investors also will increasingly ask for more compensation to hold long-term government bonds or term premium amid high debt levels, rising supply, and higher inflation. Central banks are shrinking their bond holdings, and Japan may stop purchases, while governments are still running deficits. That means the private sector needs to absorb more bonds, and so-called bond vigilantes are back, as seen when market forces sparked a yield surge to punish profligate UK policies. As a result, we remain underweight long-term government bonds in tactical and strategic portfolios. We think the politics of inflation narrative is on the cusp of changing. The cycle of outsized rate hikes will stop without inflation being back on track to return fully to 2% targets. In our view, as the damage becomes clear, the politics of recession will take over. Plus, central banks may be forced to stop tightening to prevent financial cracks from becoming floodgates, as seen in the UK when investors took fright of fiscal stimulation plans. Result? Even with a recession coming, we think we are going to be living with inflation. All of this opinion are according to BlackRock. I do wish for low inflation, low interest rate, and high growth environment. However, what we want is not the same thing as what is happening in the real world. Do prepare for a deep recession because that's what's really coming next. Okay, I'm going to show you my clients David Vine and Jama's book, Ignite the Passion, Co-Create Your Dreams. It's a collaboration book, such an amazing book. And my client Taddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an amazing book. Order your copy for Christmas. And my book, Jingle Bell Magic, Ask and It Is Given. Order your copy for Christmas. You are such a good boy for watching my video right till the end. Bye.